brought to you by the Magnolia Firm. Building a business is a massive accomplishment, and selling it is one of the biggest decisions of your life. When it comes time to get acquired, you deserve the highest possible value and the best fit buyer. Unfortunately, most brokers out there have zero technical knowledge or experience owning companies of their own, let alone a digital business. That's where the Magnolia Firm comes in. They're an M&A firm specializing in helping digital businesses get acquired. Their team is made up of former digital entrepreneurs just like you, so they know what it's like to be in your shoes. To get a free 15-minute valuation and tips to maximize your exit, visit the link down below in the description. Now let's get on with the show. Welcome to the Top M&A Entrepreneurs. Today, my guest is Bill Snow. If you don't know Bill Snow, you should, because he's the author of Mergers and Acquisitions for Dummies. He's actually got a new one, updated version, Mergers and Acquisitions for Dummies. And he's been involved with over 50 acquisitions as an M&A advisor. Bill, welcome to the show.
Thank you for having me, John. Appreciate it.
Yeah. Bill, let's kind of rewind and go back and how this M&A journey all started. What were you doing before M&A and how that got started?
Sure. I had a series of jobs, sales positions. I worked for a publicly traded retailer that has since long gone, helped with a lot of acquisitions there. We were buying up little mom and pop video stores. This was not Blockbuster, one of the competitors. And I worked for an angel-funded company. I worked for a venture-funded startup. So it was trying to figure out what I was good at, what I wanted to do. And I got to my late 30s, and a former colleague went to work for a small investment bank, and they were looking for someone who could speak on the phone and knew how to sell and could read a balance sheet and so forth. And they offered me the job to be an investment banker, and I turned it down. And I turned the job down, I think 4 or 5 times. And then I got a call from the owner of the firm, and he caught me in a moment of weakness. And so I said, okay, fine, I'll go be an investment banker. So I'm exaggerating a little bit, really not that much. And so that was in 2005 when I started doing transactional work for the middle market.
Yeah. And what kind of companies was that transactional for? Just across the board, agnostic? What was it?
It was agnostic. A lot of manufacturing, distribution businesses, some business services as well.
Yeah. Why? So tell me, why do you think he kept working on you? What characteristics does Bill Snow have that he goes like, I got to have this guy on my team?
Well, a former colleague who knew me well was working for him, and they were looking for another person, another execution person, somebody who executes the mandate. So the way I divide M&A is you've got the business development, the front end, the marketing, whatever you want to call it, materials preparation, and then the execution, someone who gets the books out, makes the phone call, sets up the meetings, negotiates the deal, and so forth. And I guess they couldn't find the right person. So he called me a few times, and I remember it was Memorial Day weekend, 2005, and he said he wasn't going to take no for an answer. Part of it, too, is the firm was out in the suburbs. I'm in downtown Chicago, and I really wasn't that keen on commuting for 30 miles out to the suburbs and the terrible traffic in the Chicago area. So when he told me he's in the process of moving the firm downtown, that made the decision a lot easier, too. Okay, fine, you got me. I'll go be an investment banker.
So he brings you on board. What was the first deal that you worked on?
It was a small deal. It was a spin out of a printing company. They had a bit of technology that they were trying to sell off and monetize this bit of technology. And so we spent a lot of time trying to find a buyer. We got a couple offers, and it was one of the first. We did not get a deal done. The client kept turning down transactions. They were never enough money. And that was one of the first lessons I learned, that M&A really is supply side. You bring an asset to market, you're going to get bids. The only question becomes, are the bids acceptable to the seller? And in this case, the bids were not acceptable to the seller, but we got multiple bids. And sadly, that business ended up failing, and they probably should have taken at least the little bit of money. It was a couple $1 million we were able to get.
Yeah. So you guys came up with the valuation, and you thought that was reasonable. Was the seller being unreasonable about the valuation, or just had the wrong number in his head?
A little bit of all of that. I think valuation, that exercise that investment bankers do, is helpful, but it's ultimately an academic exercise because an asset is worth only what somebody else will pay for it.
Right,
So we did get multiple offers, including those that said no interest. So in other words, they bid zero, and that's a bit of intel. That should tell you what people think of something as well. And the amount of money, again, it was a few $1 million, relatively small. I think they had stars in their eyes. They wanted more money. Who wouldn't want more money? But it wasn't enough to move the needle, and they decided not to move forward.
Yeah. And what about the next one? What was the first successful deal that you went through in the process?
Sure. We sold a marketing company that had run aground, so to speak. It was about a $20 million business and had expanded, built, had opened up some offices in some other cities that were losing money. It had a big client that was an every other year type of client. This was a company that helped organize events and things like that. And so it was kind of a bit of a foolish thing. They did not have this client lined up for the coming year. It was an every other type of year deal. And so they were looking at a situation where they were basically running on vapors. They had a line of credit that was being used to support some other offices they opened, probably shouldn't have opened them. But the company was very creative, had some great people, did some really good work. And we were able to find a strategic buyer in the space that was able to buy that company. It was a company that did a lot of kind of boring stuff, setting up curtains and chairs and stanchions and things like that. So they were looking to add a creative flair. So in addition to handling all the blocking and tackling at an event, they could handle some of the creative things and help convey a message in addition to just setting up chairs and doing things like that.
Well, with a company on cash flow on vapors, how do you price that? What do you say? You'd be trying to be transparent with and disclose with the buyers. Like,
sure,
it is what it is. What are you going to, what's your offer?
Sure. Well, that's what you have to do. Yeah. We do not price something. We do not say, here's the manufacturer's suggested retail price, give me your best offer. We provide a lot of information and ask a buyer to come back and say, what is this asset worth to you? And what I've learned in this business as well is they will push us. And those of you who have dealt with me in the past trying to buy something from me, you've probably heard the same line. If people ask me, I say, I'm not going to give you a price. I'm not going to do it for a couple of reasons. One, if I give you a number and you were willing to go higher than that number, I've just done a disservice to my client. That makes no sense. If I give you a number and you were willing to go higher and then you use the number I give you and some other group bid higher, I've just given you bad advice. So I'm not going to give you any information. Take a look at the materials, read it, study it. Everything you need to make a fully formed offer is found in that book. Come back to us with a deal that you can support and close, being mindful that you have competition.
It's kind of a blind auction. Do you guys do a quality of earnings report for the?
A good question. It's something that I used to poo-poo because I thought, we don't need the sell side QOV, quality of earnings. I can negotiate anything. I get these things done. But increasingly in the last few years, I strongly recommend anybody who is thinking about selling their business to do a sell side quality of earnings. So we don't do that work. We're an investment banking firm, but we will work with other accounting firms. Sometimes they'll have that already, or we can refer accounting firms to come in to do that quality of earnings.
Yeah. Do you do any reps and warranties insurance on you recommend, or same thing, third party?
It's the same thing with the rep and warranty insurance. That's something we don't do. We're not an insurance company. We're seeing that more and more where the pricing for the product, the rep and warranty insurance, has come down, where the smaller transaction, it is something that is more feasible for them. So if it's of a size, big enough where it makes sense, that is something that we do recommend, where a few years ago that was not something that was that common, probably because they were for really, really large deals. And
it's definitely come down. I actually know some people doing SMBs now.
Okay.
2 firms.
Okay.
So how does a firm like yours get paid? He brings you on. Is it, you guys get paid for some kind of retainer and then percentage of the total transaction? And that's a pool split up with everybody working for the company?
Yes. So we get monthlies, retainers, if you want to call them that. And those typically offset against a final success fee. That is usually somewhere around 3%, might very smaller transactions that percentage fee might be larger, but it's usually right around 3%.
Yeah. And then you get that percentage. Is that around 5-10% of the sale price? Is that kind of the right range, or do you take higher?
For the
For a
success fee?
success fee commission. Yeah.
Well, again, it's the size of the transaction is going to be part of that. So if it's a smaller transaction, we might have a minimum fee. And so ours is typically 300, although we should probably adjust that. So if it's a smaller transaction, the amount of work that we do is going to be the same. In fact, if anything, the smaller transactions are more complicated and require more hand-holding and pounding the table and explaining and negotiating and all those sort of things. Not that a big transaction is easy, but there's more work. And just because it's a smaller transaction, it might be 1/10 the size of an earlier transaction, but we're not going to have 1/10 the work. So we want to have that minimum fee. So if it's a smaller transaction, well, I tell clients or prospective clients, here's what I'm looking for. Here's how we get priced. Our fee that we'd have to get is probably going to be usurious. You're looking at a $3 million valuation. We would take a guess. After sometimes you kind of stick your finger up in the air and and we'll do a lot deeper dive on the valuation. But look, this is the amount of work that my team will have is going to be the same. It's not going to be 1/10 the work or 1/2 the work just because it's a smaller deal. So I have to charge this. So it self-selects. So we've had smaller transactions that they were comfortable with that and happy to pay it. And if they don't, we get it as well if it's too pricey for them.
Yeah. So fast forward, you've worked on 50 deals. What kind of area do you? And I got to tell you, back to your mergers and acquisitions, you really outline over 339 pages of every step in the process. Like, what processes do you like and dislike of this whole M&A game?
In terms of different types of businesses, or in terms of the buy side or sell side? Or?
Yeah, the sell side. Do you like, reaching out to, 500 private equity firms and, sending an anonymized bullet list of their highlights and then going through this process? Or
the best part of the job, the most fun, is the negotiating part of the job at the end.
Yeah.
I do a lot of the front end business development, which this is obviously part of it. And I've got all kinds of thoughts and philosophies on that. I call myself the accidental marketer. How I got the book in the first place was kind of a funny chain of events. I did not seek out a publisher; they sought me out. I enjoy that. I enjoy doing this. I enjoy speaking and I enjoy writing. So those are some of my favorite things to do. Putting the book together, I did years ago, I did my strengths and weaknesses myself, what I was good at, what I liked, and most importantly, what I did not like, what I was not good at. I've written books. I've spread the numbers. I've done the research. I'd prefer not to do that. I'd rather have other people who enjoy doing that and have those sort of skills, especially the design and the layout. I do not have good skills in terms of just making a document look good. Forget the words and the story that's being told. Just there's a certain flair that some people have that I don't. So I enjoy the front end marketing. I've spent years doing the execution piece, the negotiating part of that, getting the materials out and setting up the meetings. And then the most fun was the jousting and all that goes on with negotiating the deal.
What is the jousting you're talking about? Are you got a couple big egos into the room and then you're trying to get them to, hey, if you get the price, we get the terms. If you get the terms, we get the price, right?
Yeah. For me, you say negotiating, and it's funny. People who don't negotiate, they view it as one thing, bluffing. Because I will say that negotiating, especially in M&A, is very much like playing poker. And if you haven't played cards with your friends, you don't have to be some big gambler. I'm certainly not, but I've enjoyed playing cards with friends. If you don't know how to do that properly, I think you're at a disadvantage in this line of work. And here's why. People who don't play cards think poker is just bluffing. And yeah, that goes on. But the key skill that you learn when you play a game like poker or other games of skill, the same skill that you need in investment banking, in negotiating, is understanding your hand, reading your hand in as best as you can determine in comparison to the other hand. You have to learn how to play a weak hand. You have to learn to play a strong hand. If you have a weak hand, you can't push. You have to get out of the game as quickly as possible with as little damage as possible, or as the best deal that you can put together. If you have a strong hand, and this is where a lot of people make a mistake, this take it or leave it, and I liken it to, I remember years ago playing with somebody who had a great hand, and he started betting very high after we anteed. Now it's the first round of betting. Well, he signaled to everybody he had a great hand. He chased out everybody, and he won the ante, a small amount of money. And he had a great hand. That is misplaying a great hand. And the same thing can go on in M&A. If you have a great hand, a great company, but you're too aggressive, we're going to get all kinds, you tell the buyers, we'll get all kinds of great offers and you better hurry up. What happens is they just might all back away. And so you've taken this great hand and you've greatly diminished it. So the biggest skill is understanding that. And each deal is going to be different. It's almost impossible to come up with a one-size-fits-all approach to negotiating, because you have to understand the specifics of the company, where the company is strong, where it's weak. Each of the buyers might have a different angle, different approach in terms of what they see in terms of the value. And figuring that out, to me, is the most fun. And being creative and listening to the other side, because you're not going to get a deal done. It's not force of will, and we have to completely win and get everything from the other side, or we have to completely capitulate to the other side. You have to figure out what the other side, what motivates them, what you have to offer, and how best to structure something. And the best way to do that is have conversations, explain your position, and hold firm. And that is my absolute favorite part of this kind of work.
Yeah. Do you know, like, cards, how to make a call and say, hey, I have a prediction mathematically, they've probably got X cards in their hand, so this is all I'm going to bet, versus just being able to make a call on a hand. I know what they have. They know what they have. I'm going to make a call on this.
Sure. Well, I'll give you an example. We had a client years ago, and the client, or the buyer, made a strategic error. And they sent along a spreadsheet, and they disclosed all the information, or all the fees they had paid to the different accounting firms and law firms and other consultants, environmental consultants and IT consultants and consultants to consultants. It was $1.6 million on a $40 million transaction. And that was a huge strategic error. And so they tried to renegotiate the deal, lower the price. We had disclosed that we had some slow-moving inventory. The company tried to move into a market they were not familiar with, and they were stuck with a couple $1 million of slow-moving inventory. We had disclosed this, but in the last hour, they wanted to use that excess inventory that they thought was going to be unsellable as a way to lower the earnings of the company and, of course, lower the valuation, what they might pay. And so we had a meeting at lawyer's office in just outside of Detroit, is where our lawyer was. The company was someplace else, and it was a contentious meeting. But I told my client, let's hold firm. They cannot go back to their overlords at this big private equity firm and ask for $1.6 million, because the bosses will say,
they were looking for a $1.6 million concession somewhere in there.
Yeah, well, it wasn't that much. They wanted more than that. But what I knew is that buyer could not go back to their bosses and say, we need $1.6 million. The bosses would say, oh, great, you got the deal done. No, we didn't get the deal done. We just need $1.6 million to pay off all the lawyers and the 2 accounting firms we hired and the 2 law firms we hired and so forth and so on. So I knew that they would have a much easier time to get that money if they were also able to bring home the deal. And so we held firm. I wanted to hold firm. I was chomping at the bit to say, you guys have an airplane to catch. See you later. But my client did blink a little bit, and it was probably a good thing. So we conceded, or we agreed on everything. There was one small minor concession that we made at the end. And just as well, I'm a big fan of that too when you're negotiating these things. If you can give the other side the last victory, so you've won the war, but they've won that last little skirmish or battle, they can go back to their side and say, look what we extracted. Look what
That's
we won
what they'll remember.
Yeah. So, and the funny, Coda is one of the PE guys years later, showed up at my office. And by this time, all the dust settled, so we're friendly. And he said, I've got your book, Bill. I want you to sign this. And you better write something funny. Oh, great. Now I'm under pressure to write this. So I'm thinking, well, what can I write? And I said, Justin, thanks for the house, Bill. And it was a nice feat.
And his reaction to that was, he's like,
he laughed. He thought that was very funny. Yeah.
So how many deals did you get accomplished before and where this idea to write a book, Mergers and Acquisitions for Dummies?
Oh, I probably worked on, and some things were in process, probably 20 transactions at that time. And we had,
Yeah.
I've kind of lost, 10, 12 closings. And we were doing buy side work as well and sell side work. So it gets a little blurry. One of the buy side clients, we bought a bunch of companies from somebody. There was kind of 3 separate transactions all in one throw. So it gets a little muddled in terms of being able to say exactly how many, but 10 to 20 that I had worked on, and most of those had closed.
Yeah. And then and you were just going to write an all-encompassing book. You didn't have, you just said that Wiley Brand came to you for the Dummies. Did you write the book first? Building a business is a massive accomplishment, and selling it is one of your biggest decisions of your life. When the time comes to get acquired, you deserve the highest possible value and the best fit buyer. Unfortunately, most brokers and intermediaries out there have zero technical knowledge or experience owning companies of their own, let alone digital businesses. That's where the Magnolia Firm comes in. They're a specialty M&A firm specializing in helping digital businesses get acquired. Their team is made up of entrepreneurs, so they know what it's like to be in your shoes and how to get you to the finish line. If you want to sell your business, get in touch with the folks at themagnoliafirm.co.
Fabulous question. Everybody always asks me that. The other question I always ask is, did you really write it? They think I had a ghostwriter. They hired a nobody and hired a ghostwriter to write it. The story about that book came, and it's a great marketing lesson for all of us. This is 20 years ago when I was still trying to do the venture capital game. I had a meeting with a venture funded company. They wanted to raise some money. They were going to hire me to go raise some more dough. They'd had friends and family put money in. They wanted to go to the VC world. Okay, I can do that. So I met with the chairman, who had put in millions of dollars for this. We did not have a good meeting. He pointedly asked me, what the blank do you know about venture capital? He did not say blank. And it was not a good meeting. And I was so upset that I had this little article that I had been working on, didn't know what I was going to do with it. And I just started writing this article and then expanded it. It'll be a 2-parter, 10-parter. I'll make it a book. I'm going to weave a narration through it, have some fun with it. And I called it Venture Capital 101. It was just the spur of the moment decision. I wrote it in about a month. I gave it away as a PDF. And I was a very, very small viral hit before viral hit was a term. This is about 20 years ago. And I remember getting all kinds of offers. VC firms in California were thanking me, and all kinds of people were offering me good, bad, and different things. And I remember thinking, if I knew what I was doing, I'd be able to hit the accelerator. What I realized is it was basically a book for venture capital firms. This is what you don't do if you want to get venture capital. So I was kind of the polite conduit. Shortly after that, that's when I went to work for the middle market investment banking firm. And a few years after that, Wiley contacted me. That little PDF that I wrote, little booklet that I wrote, where I claimed that Keith Richards' guitar tuning was a paradigm for venture capital. Seriously, it's in there. I go through that because I just figured that out for the guitar.
I wonder
just have some fun. But they contacted me to write a book, LBOs for Dummies. I said, who would buy that? They said, the big guys on Wall Street do billion-dollar deals. I said, there's 6 of those guys.
How would they make money on that? If it's the big guys, we're talking, what, 500?
Yes. Sorry to keep going on. I suggested M&A for Dummies. They said that's a bad idea. Who would buy that? I said, I don't know, tens of thousands of business owners and executives. That's a bad idea. They called back 2 years later with a new idea. M&A for Dummies, mergers and acquisitions for dummies. We thought of it, Bill, not you. Would you like to write it? I'm exaggerating a little bit, really not that much, but I'm very thankful to Wiley for reaching out to me. And it was a long gestation, but it's been very rewarding to be able to put that book together.
Yeah. And did they put you under contract, or you just said, I'll write it and I'll deliver it, and they come back and forth and make some corrections, edits and stuff?
We spent a whole summer of 10, about 3 months working on the contract. And we finalized that. Actually, part of it is when you do this, as you're working on the contract, you're also working on an outline that has to get approved. I think it's the Grand Poobah is what they have at Wiley. Grand Poobah sits there and everybody comes, they pay fealty, and they say, would you bless this book idea? And they kept rejecting the outlines that I had, the chapter by chapter outlines.
And they would know the outline of an M&A process. Why?
Yeah.
How?
Yeah. Well, I mean, part of it is, and I see it now, these books are supposed to be a reference book. So I was thinking more serial, starting point, ending point. I was going to build out from there. They wanted this to be a reference book. So what's the letter of intent? So you can look that up in the at the back of the book and see that's on page whatever, and then read the paragraph or the page about that. So these outlines kept getting rejected. The acquisitions guy I was working with at Wiley said, let me take a stab at it. I think I understand the subject matter after reading all these outlines. So he wrote this thing that was a disaster, and I thought this thing's going to die. And much to my disappointment, it got approved. And so now I've been approved by a major publisher to write a book with an outline that makes no sense. And then I signed the contract. And so this is what you do, people. While he's watching, they'll probably be upset at me. When you sign the contract, you've been approved to write a book. You have no idea how you're going to write it. You read the contract, and it says very clearly, upon signing the contract, they're supposed to give me a little bit of money. It took a month for me to get that money, and that was just enough time for me to refigure the outline. I began writing the book. And then the next thing, when I was turning in chapters that didn't line up with what Wiley agreed to, this is what you do when you're writing a book for a major publisher and you're doing something, you're kind of going off the ranch, so to speak. Don't answer your phone and don't look at email. So I did that for a couple of weeks, and but the most important thing, they are terrified of hiring an author and not getting the book done. I kept turning the work in. I think it was good work. We had a come to Jesus meeting at some point and said, we're going to do it my way. And that's what ended up in the book. And I'm quite pleased with the book. And they came back years later. We've now done a second edition.
Yeah. Curious, did your firm require, did you have to give anything revenues from your firm, from your knowledge, learning about transactions and M&A?
No. Don't give them any ideas. No, I would not do that.
Yeah, thanks, man.
I would not do that, because I write this soup to nuts, and absolutely not. And I appreciate the question. It's an interesting thought. It hasn't come up, but absolutely would not share anything. That's my little baby. Don't make a lot of money on it, but I make money on it. But more than that, it is mine. I own it. The ideas, all the layout, everything in there is mine. And also, what was very important to me is writing that book taught me that I'm not a writing or a reading preference learner. I'm a writing preference learner. So I experience, I do things. Then when I wrote that book up, it forced me to think through a lot of things, the process and the steps and how to explain things.
Like crystallizing the process is interesting, isn't it?
Yes.
Doing it, and I do it every day, but then you crystallize it so somebody else can do it.
Yes.
Yeah.
Invaluable. So that's part of where I started thinking about, well, how do I learn? What am I good at? Good at putting words together, good at explaining. I'm good at taking a complicated subject and explaining it in a simple, easy to understand manner. That's why I've written a For Dummies book, right? What am I not good at? I remember when I got the first copy of the book, my housekeeper was there. It was a Friday. I was home, and I held up the book, and she didn't care. And I'm looking at the book. I'm really proud of myself. And I'm looking at the empty walls in my house, and I realized, I'm pretty good at this word stuff, art, the visual design. You can see all the incredible artwork behind me in my office, right? There's a window. I don't have an eye for that. But that to me was very valuable. Instead of trying to do everything and think you're an expert at everything, because none of us are, I have a very good idea of what I'm good at. You better get out of my way, and what I'm not good at. And then I look for partners. I look for colleagues who have those skills that can bolster up where I'm weak. And it's been absolutely freeing for me to focus on and understand what I'm weak at, what I'm bad at.
Yeah. Well, I'm just curious, what grade level is mergers and acquisitions for dummies written at? You know how they say, right, for eighth graders?
Yeah, good question. I didn't think about it. I would say high schoolers would be able to, probably even junior high. I don't use a lot of big words. I have some fun with words because I like that. But I think the concepts of, it's a little bit complicated. When you're getting into accounting, I think you'd have to have a little bit of growth and development. So I would think high schoolers, but probably an eighth grader would be able to comprehend the book as well.
Yeah.
I don't know how much they would be able to understand, because I think being in business to some extent is helpful to give you kind of a foothold on it. But certainly the basic terms and so forth in the book is written. So the way I put it is, even I can understand it. That's how I write the book.
Yeah. Well, so what did the publishing powerhouse Wiley brand and going under the brand of For Dummies do for you? How many original copies did they print? Say, hey, we're going to print 100,000 or 10,000?
Look, I wish it was 100,000. I I think they printed about 2,000.
2,000.
We've sold. Yeah, I have no idea. This was a leap into the great unknown when I did this. So this was back in 10 when I wrote the book, and the book came out in spring of 11. I've sold, I think, roughly 40,000 copies over those years, which is pretty good. I mean, I'm not going to get rich, but I get, twice a year I get a couple grand, which is better than nothing. But my only goal when I wrote the book is I just wanted to sell enough where it stayed in print, and what that was, couldn't tell you. I think I have a sense of it now because obviously it stayed in print all these years, and I'm very fortunate Wiley came back and we were able to put together a second edition in the last couple of months. Yeah.
Well, heck, man, you got 384.5 stars on Amazon. So you've definitely sold quite a few copies. But in reality, that's not why you write a book, right? Most books don't make money, but it opens the doors. How did that change your M&A career, having this book?
Well, it opens up doors. It becomes a form of third-party validation. Some people like it, some people don't. When I signed the contract and I was writing the book in fall of 10, I had a meeting with a business owner, and he looked at me and he said, well, what do you know about M&A? Almost a repeat of that question, what the blank do you know about venture capital? And I had to bite my hand because I thought, oh, this was just teed up perfectly. Well, I wrote the book. But I couldn't say that. Yeah, I wrote the book. And so I because it wasn't done yet. It wasn't out. I had no idea if it would be good or well received. And actually, I'm still in contact with that guy, actually. And then shortly after it came out, I had a meeting out in California, and I went out there with a colleague, and I brought the book, and I was just chopping at the bit at the latest at the right moment, just the earliest moment to be able to say, here's the book, I'm an expert. And it came up, and I kind of forced the hand, and I gave him the book, and he looks at it, kind of scoffs and tosses it aside, and he says, well, I'm not a dummy. And I said, well, look at the author. So that one backfired, but it has opened up other doors. It is something that some people find cool. It's interesting. They always ask the same questions. Who wrote it for you? Did you write the book and sell it to Wiley, or did you pitch the idea? They came to me. I had to come up with the idea, all those steps that I explained earlier. It has opened up other doors. A group overseas reached out to me. So before the pandemic, I was going over to Dubai and Malaysia and doing M&A presentations. I'd done that 2 years in a row, and I was looking forward to doing that for the rest of my life. And hopefully that comes back, who knows? But I was in talks with other groups, and I thought, boy, this would be great to be able to do a lot more, get on airplanes, fly halfway around the world, and talk for a day or 2 days. And I really enjoyed that. So those sort of opportunities never would have happened. And again, I have to go back for people thinking about writing or how do you differentiate yourself. Think about that. I was upset about a business meeting that did not go well. I wrote something. I had some fun with it, had a bee in my bonnet, so to speak. That led to a major publisher contacting me. That led to an overseas group contacting me to do speeches. Of course, you get paid for this as well. So all these things opened up. And the key thing is, people know me, have heard me say this, things in life happen when you have something to offer, when you're asking all the time, give me a job, give me this, will you do this for me? It's a lot more difficult than saying, I have this, here's what I'm an expert at, here's what I can offer you. And that's been a big approach for the way that I try to market myself, the services for my firm, trying to figure out some way to differentiate ourselves by offering, not just asking. Think about everybody watching this. Think about all the yahoos that contact you on LinkedIn. Everybody's trying to sell you a bespoke suit and fractional jet and insurance and on and on and on. And how often do you say yes to that? The whole world is asking. If you can figure out how to offer something, that's when the doors start opening.
Yeah. But you've pre-framed them because if somebody types in Bill Snow, they're going to see your Amazon listing, then you're going to see your book listing, you're going to see all kinds of stuff, and they're going to make form an opinion of you before they even meet you. Sure. Which is a pre-sale. Yeah.
It absolutely helps. It helps when you talk to other firms. Like I said, it's having that book is a form. I view it as a form of third-party validation. I wrote it initially just for myself. Just, can I do this? And it's funny. I'm a good writer. I still remember cringing when I was in school and high school and in college and being assigned the 10-page term paper. Oh my God, that was torture. How can you write 10 pages? I can write 10 pages,
Like any college kid can write 10 pages today.
Yeah.
They just go to Chat GPT.
That one.
And write it in Frank Kern style, please. There you go. Oops.
It's that's technology. Yeah, but it's sad because I did work very hard at writing. I didn't think I was a writer. Till long in my life, even though I'd always enjoyed doing that and being able to express things. And I do it for myself because I have to work out how to explain something. So whether it's a business thing or something else, I have to work it out in my mind, and I can play around with the words. And so the technology we have today, not necessarily all that AI stuff, but the computer. I would not be able to write and do what I do without word processing programs and being able to move sentences around and words around and try different things. Having to write longhand and then type it up, that was laborious. So the technology to some extent is a huge boon to my writing.
Yeah. I have to ask you about, so what's the difference between the mergers and acquisitions for dummies that you released in 2018, your first edition, and the second edition? What's the difference?
Yeah.
Aside from you've got 30 acquisitions under your belt now.
Yeah.
Plus the
sorry. We go into some of the changes that have gone on in the industry. So we've talked about it before, the quality of earnings report. So I go into a lot of detail of what that is and why business owners should do a sell side Q of E, quality of earnings report. We talk a little bit about the rep and warranty insurance, which was barely on the radar 12 years ago. I go into a lot more detail in terms of valuation, and this is something that's come out from my thinking and working on deals, both buying and selling companies, the different ways of looking at valuation, the different components, what really drives valuation, and what business owners can do to help their valuation. Little things like if the business owner is not needed, right, the company's going to be worth a lot more. And so we have a lot of...
How much? Let me ask you that.
Sure.
If the owner's not needed, only shows up 10 hours a week to just hang around, you got a general manager, what does that add to the valuation? And I guess it's always going to have, well, it depends. If you're a $5 million company versus a $20 million company.
Yeah. You gave the succinct answer. It depends. There's that's what someone told me years ago. These people that they get these fancy MBAs, the first thing that they teach them is, well, it depends. That's what you're supposed to say anytime you get a question. But it really does. It's a difficult thing to say one size fits all, because it depends on the industry, other factors in the business. Do you have recurring revenue? Do you have a lot of capital expenditures? A lot of other expenses? Do you have a long sales cycle? On and on and on. So there could be a lot of factors that go into a business that have an impact, a positive impact or a negative impact on the valuation. A manager or an owner, rather, who is not needed certainly is a very helpful thing. The business runs itself. We've got a great team. And now, Mr. Private Equity Firm, you can come in there and everybody, the management team knows what's going on. Those are good situations. When an owner needs to be replaced, that's trickier. But again, depending on the deal, maybe a little bit smaller transactions. Sometimes you have some of these smaller, I call them smaller PE firms. They don't have necessarily limited partners, but maybe a guy or a couple guys or a couple gals own a firm or a couple companies, and they're always looking to buy some more. Maybe somebody, or they have somebody in their circle who wants to operate a business. That becomes a good fit too. So somebody has the capital, access to its backing, and is looking and has the experience and is looking to run a business. Well, that becomes a good situation when you have an owner who wants to segue out, maybe that owner who is integral to the business and pretty much in the middle of everything, assuming that owner is open to doing some sort of a transition, 6 months, a year, 2 years, whatever the case is.
So what is the biggest area, what you see that's difficult to tackle? I mean, I'm going to focus on valuations because you see this guy, 72 years old, he equates his retirement with the day to sell his company, and then you got to figure out a valuation. But you don't tell anybody else, buyers, you don't tell what your valuation is, but you got to figure out some kind of valuation, what you think it's worth, right?
Sure.
Yeah.
What we'll do is, and a lot of other firms do this, is we'll run we look at 4 ways of looking at valuation. So we'll look at comparable transactions as much as you can find them. It's difficult. Privately held companies, when they transact, a lot of times that information is not public. So sometimes you have to look at public transactions, and maybe these are much bigger companies, but it's the same kind of business, just much bigger. So maybe you can make some assumptions for size to bring those multiples down. We'll look at companies, publicly traded companies in this sector. And again, publicly traded companies are going to be much larger, but that becomes a very good metric too when you see the stock price, because you can figure out the PE, and that's going to tell us in most cases a business is going to want to acquire a business that is accretive to the earnings, right? They're not going to buy something and have the earnings per share decrease because of the acquisition.
Yeah, and none of that distressed stuff.
Yeah, exactly. So that gives us a ceiling. Okay, well, this is a check in terms of what a business might be worth. We'll run a LBO, leverage buyout, which is the typical valuation form for private equity firms, and we'll do the discounted cash flow, which is the fantasy of all college students everywhere who picked up their first finance book. So we'll look at all 4 of those, and we'll take a weighted average of those 4. What I tell people is that tends to be a pretty good academic exercise in terms of what valuation is. But ultimately, something is worth what somebody else will pay for it. And what we want to find, and you can't guarantee it, I can't say it's going to be there with every case, but quite often you'll have an acquirer who has a strategic imperative to make the acquisition. Yes, they understand all those numbers, but this particular company offers products that fill a hole in our product offering, or we're taking out a competitor that's just been a big pain point to us, or any other myriad factors that might go into making an acquisition. So if a buyer has that strategic imperative, they really want it, aren't they going to pay more? Probably, especially if they're in a competitive process, which is why I always ask buyers when they ask for a price, read the materials. Everything you need to make a fully formed offer is in that book. Please come back to us with an offer you can support, close, being mindful that you have competition. And that's I think the best way to elicit and draw out that best valuation.
Yeah. Have you ever gotten an offer that's 10x what you guys did on your weighted average and go, holy cow, these guys are strategic.
Sure. Oh yeah. Every single deal we work on, it's at least no. We've
well, you had some that you like, hey man, thanks for buying my house.
Yeah, no, every deal. Yeah, you hire us 10 times. Piece of cake.
Yeah. This is something we don't tell, but yes, yeah.
Yeah, it's. I can't say 10 times. Usually the offers come in. I mean, sometimes they're a little bit low and lower than you want, but that's why you get multiple offers. Well, that guy was kind of low, but here's some others that are more in the range. So usually they're in the range. Sometimes you do get a wow factor, and even if you get a wow factor, you have to be very careful. What is the form of that transaction? Is it all cash at close? Or are they giving you a big note? Are they asking you to take stock in another company? Is it an earnout? Those earnouts have become kind of a Frankenstein's monster, in my view. So what is the form of the transaction? How much cash are you getting at close? How much risk do you continue to take? So you might have a big transaction that they say is worth, I'm just throwing numbers out here, $30 million. But if they're only putting $10 million cash at close and $20 million in a note and some stock and an earnout and some other things, well, maybe that is a good deal. But maybe a $20 million substantially all cash at close deal, maybe that's better than a $30 million deal with a lot of structuring. No right or wrong. It depends on the seller. It depends on the situation.
Yeah. I got a question for you. I saw this deal on Generational and I asked about it because it was in the IRS accounting kind of field software. I got the NDA, I got the SIM, and then 80% of their business was from one customer. Yeah. And, it was on Generational. They don't price those either because they're expecting a strategic to buy it. But as a financial buyer, I couldn't accept that. I'd price it at the 20%, right? That's how I would look at it. I mean, do you take those clients, say, no, we're not going to take you, or do you fix them? And go say, hey, look, we need to mitigate this risk here for clients to get to a better valuation.
It is a big risk, and again, you'll know it when you see it if you can work with it. 80%. What is the nature of that? How strong is that relationship? We've sold companies that had maybe not 80%, but we've had them that 40, 50% with one customer. The the challenge is a lot of times these business owners have these big concentrations because why? They're doing a good job. They're doing a good job, and that client keeps coming back, or other departments or other units in that company. Hey, I hear great things. Could you do the same or similar for us? What are you supposed to say? No, I'm going to turn down some profit here from doing what we do. So a lot of times that growth in that terms of that concentration happens organically because of that. So it's tough to turn it down. In those situations, what is the nature of the relationship? Are there contracts tied to this? Is it just we hope every month the phone rings and we make a bunch of sales? And then also, can you find a buyer who has a concentration elsewhere that maybe isn't using that big 80% customer? And maybe that 80% customer is a fantastic company, well run, big company, well regarded, and looks like they're going to continue to do that business. It's the type of client that anybody would want, but the buyer doesn't have that client. So maybe that makes sense to acquire that. So now you don't have an 80% concentration. Maybe
It
that
drops down
concentration
to, small
40%,
minority.
30, 20, right, exactly. So it really depends on the situation.
Yeah, I've encountered that before, especially somebody had a concentration in Texas, and I go, well, I only got 2 customers. It's like Shell and Mobile. Like, okay, yeah, I get it.
Yeah. I mean, well, it's automotives. Yeah, we sell the OEMs. Well, how many are those? There's in Detroit. There's just a limited number, but they're big companies, and so it really depends. So it's kind of hard to give a one size fits all answer, but it really depends on the situation.
Yeah, I see. That's one of the reasons why you bring in that quality of earnings a little bit more into these.
Yes. If that report is done right by a reputable firm, they will look at that. They'll be able to talk about the nature of those ongoing revenues, in addition to normalizing owners' compensation and the, all the one-time only expenses. Are they really one-time only? Timing issues as well. Is a company lining up its revenue and the corresponding expense? Are there any issues there? So, the QOV is hugely important, and to keep waving that flag, I always tell business owners, you're asking us to go into battle and our flank is exposed if we don't have this report. It's much better for us to be able to go into a process and say, here's the adjustments to EBITDA. Here's how we're seeing the earnings of the business after you, Mr. Buyer, after you take over the business. And we have another firm, a reputable accounting firm, has come up with this that allows us to grab that high ground. And then the buyer has to come back, and they're going to ask questions, and that's fine. And we're happy to interface with them or turn them over to the accountants. But we've grabbed that ground in terms of how we see valuation. Instead of waiting for a buyer to come back and say, here's where we see the earnings, we're making the other side come back to us and fight up the hill, so to speak.
Yeah. I want to ask you about in your new book, Selling a Transaction, Selecting Advisors. Now, you just recommend these advisors, or why are you pointing this out? Like, I'm the tax man on page 185.
Why we recommend advisors?
Well, I mean, what's like, hey, by the way, you're going to be selling $30 million, and you're probably not going to get $30 million all in one time. It's going to be $10. It's $30 million you brag about to your friends and stuff, but you're going to get $10 million, then you're going to get $20 million, and then if the private equity firm sells your portfolio in 5 years, you're going to get a bigger pie, et cetera. This is what your tax bill is going to look like.
Well, I'm not a tax accountant or attorney, much to my father. My late father had a master's in taxation. He was a CPA, so he'd be disappointed. He went back to grad school in his 40s just to get that skill set. We strongly encourage business owners before they retain us to talk to their tax people, to understand what transaction makes the most sense. Selling assets, selling stock, does it make any difference? What's the basis in all of that? Is accounts receivable going to be taxed at a different rate than the rest of the business? Is that considered cash? There's just myriad factors that go into it. And I know enough to ask the questions, but I want an independent voice to be able to come back and say, here's the type of structure that is going to be tax advantaged for my client. And then once we get that, we can communicate that in the book, in the SIM, when we go back or when we go out to the market and say, here's what we're looking for in terms of, we're not going to put down the price, of course, but we're going to talk about the type of structure that we're looking for, and explain that it's tax advantage. And if we can do that ahead of time instead of waiting until negotiating the purchase agreement, that's where you want to be able to explain that, to give the buyer, to be fair to them, to give them as much information as possible so they can put together, again, a fully formed offer.
Yeah. Let me jump to chapter 19 of your new book, 10 Reasons Acquisitions Fail. And
you're not going to ask me to recite them. I'm not going to have to recite them by memory, am I? I have to, oh my goodness.
In Bureaucracy, 334. You don't spend a lot of, you only have one page for like 3 different sections, but the zombie and responsibility with no authority. What do those 3 mean? Reporting and bureaucracy, the zombie, and responsibility and with no authority.
Well, the responsibility with no authority is, and that's they're all kind of tied together. That's where you tell somebody you're responsible for getting this done, but you can't make decisions to get it done. That is just a recipe in any sort of a business. I mean, how can you expect somebody to be responsible for something if they can't make the decision? Ultimately, the decision maker should be responsible, and that's a tough thing too.
How do you uncover that?
Yeah. Well, that's a great question. And when you're a seller looking at buyers, you do your homework as much as you can. Sometimes it's a gut feel when you meet the executives or the PE people, the principals at the PE firm. You ask a lot of questions, and you want to make sure that you have a good sense that the new owners are going to be continuing to run the business correctly and be able to trust their people. Ultimately it's out of our hands, and it's up to the buyers to be able to do a good job. So we can ask all the questions we want and do as much homework as we can, but ultimately once the deal gets done, the new owner coming in is going to be able to make those decisions. So hopefully they're able to trust their people. If it's a PE firm, I'd ask to speak to other firms in their portfolio and ask the managers, talk about the relationship. Are you still have autonomy? Do you have to approve every single thing you do, or can you talk about that? I would get that sort of information for sellers before they make a decision like that.
Yeah, I think the one example that I remember was Michael Dell's book when he was first running his company, but it was growing so fast that he had somebody walk into his office and he goes, "Hey, I just lost 50 cents in the Coke machine. I'd like to get a refund." And he's like, "Why are you asking me this?" And they goes, "Well, because you're the only one with the keys. Like, I got to learn how to delegate."
Yeah. It's a tough thing, and some people are good at it. Other people are, control freaks. They don't trust others, or it's difficult to let go. I've managed people, and I call it the lazy manager approach, where I don't want to have to do everything. I'm too lazy. You do it. You figure it out. And that actually, it's a bit flippant to, you're kind of joking around a little bit. But when you tell people that you figure it out, you're going to be responsible. Okay, I'll back you as much as I can. But ultimately, you are going to be responsible for your decisions. You don't have to come to me if you got a question or want to bounce ideas off me. That's fine. But you encourage people. That's what I've always done. Encourage people to make their own decisions. Other than that, then you end up being a micromanager, and nobody wants. Well, some people like being a micromanager. I am not a micromanager and would not want to be one.
Yeah, let me clarify that zombie. Now, what's a zombie again? Page 3.
Yeah, a zombie is a business that is sustainable. It's not going under. It's not going to go out of business, but it's maybe not growing.
It's not going to grow because the trends are moving in the other way. But people still need the product. Yeah,
they still need the product, or maybe a owner, private equity firm. You see this sometimes in venture capital. You see sometimes in private equity. You go to a private equity firm and look at when they've done their transactions. And if you see something that is more than 7 years old, that's a question. If you see something they've had for 10 years or 15 years, now maybe it's a great company and they're just continuing to get incredible dividends from it, but probably that's a zombie. So what is that? They have put in so much money into the business, and it's profitable now, but the amount of earnings they make do not support the amount of capital they put into it. They do not want to sell it and take that loss because then they have to report that to their limited partners. So that's a real problem. I've known numerous PE firms where that happens. It's not to to denigrate them. I mean, it's business. I mean, this thing happens, but a company where it's not going to go out of business. Okay, it's a nice business, but the amount of capital that's been put into this, you just can't sell it unless you're willing to take a massive loss.
Yeah, and sometimes it's like the return on equity keeps, it's neutral or it's declining. But if you get rid of that, somebody new coming in and would see it and goes, let's get rid of it. But it's like a Jenga block that could hurt other parts of the revenue for some reason.
Yeah, it could. But you're right. The longer you hold a company, the more erosion that you might see in terms of the internal rate of return. And so that's why PE firms, they want to buy a company, fix it up, maybe make some acquisitions, put the new management team in there, do what they're good at or what they think they're good at, create more value, and then sell the business. The longer they hold on to those businesses, the greater the hurdle is in terms of getting a good return on their money. So that's why the PE firms, you'll see them, they want to hold for 3, 4, 5, 6 years, something like that, then sell. Exceptions, of course, but that's why they usually want to get out after a few years.
So let me jump to chapter 20 of the new book, 10 Lurking Problems for Sellers. And I'm just going to ask you a couple questions about page 337, accruals, and 338, parallel activities. And the end run approach. What are you talking about there?
Okay.
Yeah.
Okay. I'll make a note so we get them all. So you want accruals?
Accruals, parallel activities, the end run. End run approach.
Okay. And run. Okay. Why don't we take them in reverse order? So the end around, that's when you're negotiating a transaction. I am big on having a chain of command. I think that works best. So the seller has their point person, which is usually the investment banker, and then somebody on the buyer's team is going to be that point person. Maybe the buyer is working with an investment banker, somebody like me, or maybe they've designated one of their executives, maybe the CFO, maybe somebody who reports to their CFO. Somebody is going to be the point person. And to some people, it might seem like a lot of extra steps, but when you have that chain of command, I think it keeps the odds of having miscommunication lower, reduces the odds of miscommunication. Why? Because instead of that chain of command being followed, you have somebody else making an end around and breaking that chain of command, trying to get a bit of information, and you don't know all the requests that have come in. The end around as well, if you're negotiating, it really shows up in the negotiation as well. So if I'm doing my job as a sell-side investment banker and that buyer, instead of dealing with me, calls up my client and tries to negotiate directly with my client, that's a big no-no. That's an end around. They're breaking the chain of command. That's something that we've agreed to. Certainly tacit, in fact, the NDAs that we'll sign will state that all the communication has to go through my office. So that's a bad sign. People trying to jazz it, or they think they can get the deal done faster by knocking out the middleman. Well, that's why they hire us to be the buffer, to make sure that we can convey information unemotionally and act as that buffer. So if they're trying to knock me out, it's happened. That's usually a sign that they're in a weakened position. So going back to the poker game. Okay.
And I got to say, hey, I got to remind you, we have a contract here. So if you take me out of the deal, it's unpaid twice.
It's well, you get paid anyway, but it's bad pool, so to speak, when you see somebody do that. You're talking to somebody and they're going over your head, so to speak. That is an absolute bad decision. I mean, think about it. If you were negotiating something and someone just ignores you, this is your job, you're supposed to do something, and they willfully ignore you and try to go above you, talk to your boss or talk to your client who hired you. It's unprofessional, and it makes getting a deal done, because you're not negotiating in good faith at that point. I'm a big believer in negotiating in good faith. Parallel, that gets into the notion of business owners. A lot of times when they're looking at all the things that go on with a business sale, not just all the steps that we have in a business sale process, but all the planning they have in terms of hiring us, running the business, and then what do you do with the money after you make a transaction. And a lot of times they will do things in a parallel, or I'm sorry, in a serial fashion. So I'm going to run the company. I'm going to run the company. They put their head up. Oh, I'm going to sell the company. I'm focused on sell the company. Sell the company. Now I've got a bunch of dough. What do I do with it? Invest the money. That's not so bad. Most wealth managers, I'm sure, would be happy to get that call. But what we tell them is you can do things in parallel. They don't have to do them serially, one after another. So if you are running the business, you want to sell the business, I strongly recommend, if they're not working with an advisor, a wealth manager, to hire one to help. So, because that might help structure our transaction. Again, that might get into a tax advantage situation. So business owners don't have to wait till the deal is done to work with a wealth advisor if they're not already working one. I recommend, in fact, they talk to a wealth advisor even before they talk to somebody like us. Yeah. And then the accruals, I'm going in reverse order here. The accruals are a smaller thing, but that will come up in the working capital calculation as you're trying to figure out how much working capital is going to be coming along with the business. And the accrual, especially in the vacation. So if somebody gets 2 weeks vacation and they haven't taken any vacation and it's June 30th and you're closing a transaction, a buyer's going to say, wait a minute, that person gets 2 weeks vacation, they haven't taken any. I could make a case that they would take a week in the first 6 months and a week in the second 6 months. So we should make an adjustment that I shouldn't have to pay 2 weeks worth of vacation. I should only pay 1 week, because there's these accruals. So if a company is tracking vacation accrual or other accruals, you want to understand the nature of that, and there might be an adjustment. It's usually not huge dollars, but it is something that almost all, especially all sophisticated buyers, will look at. So business owners should make sure that they understand that. And if they've been accruing vacation for years that people haven't taken, and sometimes we'll see that on the balance sheet, that is something
there are employees that do that. Yeah.
There are, yeah. And so it's use it or lose it. But if you've got, hundreds of $1,000s on accrued vacation, a buyer's going to say, wait a minute, I do not want to take that liability. And so now you've got to have a conversation with that client or write a check or something else. So paying attention to the accruals, vacation, and other accruals, very important for sellers as they try and button up the deal and get ready to do a transaction.
Yeah. Bill, thank you so much for spending time on my show, Top M&A Entrepreneurs. By the way, so if you guys want a book, get the Mergers and Acquisitions for Dummies, the second edition. It's now available on Amazon.
Purple cover. Get the purple cover.
Purple cover. You got to do a search for Bill Snow, Mergers and Acquisitions, and then scroll down just a little bit. It's right below the blue and yellow one. So,
that's
Bill,
right.
Thanks for being on the show.
My pleasure. Thank you.
I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at dealflowsystem.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.